this week's market update, the UK unveils an industrial strategy as Brexit talks reach crunch point. The US looks to life after Janet Yellen, and OPEC meets in Vienna. The traditional pre-Christmas shopping season got underway this weekend with the Black Friday and Cyber Monday sales. In keeping with the overall online shift in retail, this has become an ever more digital event. Fewer scrums in the shops, but an increasingly massive logistical exercise in the digital world. Retailers have little option but to participate in the Black Friday event, even those which initially rejected it. In the UK, Next, for example, took part this year, having held out in previous years in a bid to maintain its profit margins in the run-up to Christmas. For many retailers, Black Friday is a commercial nightmare. It brings forward sales which would have happened anyway in the following few weeks, but at much slimmer or non-existent margins. While Black Friday is good news for consumers, it's arguably the reverse for investors. Shareholders in the traditional bricks and mortar sector are already feeling the squeeze as the likes of Amazon make life more and more difficult on the high street and in the out-of-town shopping malls. The trends are most evident in the US, where massive building of shopping centres in the years before the financial crisis created a glut of space. The good news is that the shopping is still taking place. It's just happening in a different way. Online sales are expected to exceed $100 billion this November and December, and the growth in Amazon's market value in recent years has more than made up for the reduction in share prices at the old-style department stores and other retail chains. For investors, the key lesson to take from all this is that disruption of traditional sectors can be massive and long-lasting. The knock-on impact can be wide-ranging and profound. Commercial property, for example, is struggling to cope with the imbalance of supply and demand. The jobs market will be hugely impacted too. Online sales require something like a quarter as many employees per pound of turnover than those in traditional shops. So retail has been a trailblazer, but the same process will impact other sectors from hotels to automotive. What value will brands have if the idea of owning depreciating assets like cars disappears? The challenge is to be ahead of the curve, capitalising on these massive shifts in the way we live our lives before they've been fully priced in. In an interesting example of the pace and scale of disruption, the Just Eat online restaurant delivery service is expected to enter the FTSE 100 index of Britain's largest companies next month. The company, which listed less than 4 years ago, will have a market value of more than £5 billion, and it's now bigger than Sainsbury's, the Morrisons and Marks and Spencer's. Big economic changes were a persistent theme in last week's UK budget, which was dominated by reduced expectations for growth in the British economy. According to the Office for Budget Responsibility, growth in the UK this year will be 1.5%, rather than the 2% expected only 6 months ago. Growth is also expected to be under 2% for the whole of the government's 5-year forecast period, and this is an unprecedented period of sluggish activity. A key driver of this is the UK's poor record on productivity growth, which has stagnated over the 10 years since the financial crisis. Lower productivity leads to lower growth, lower profits, and therefore to lower tax revenues for the Chancellor. It became clear last week that Philip Hammond is going to find it increasingly difficult to balance Britain's books in these circumstances. His goal is to reduce the gap between tax revenues and spending to 2% of GDP by 2021 and to wipe it out completely by the mid-2020s. This looks unlikely. To tackle the productivity puzzle, the Chancellor's budget was heavy on measures to increase investment in infrastructure, both physical and digital. Then this week, the government set out a new industrial strategy with a focus on improving Britain's skills and attracting investment from the industries of the future. Many of the measures outlined in the 250-page report have already been flagged, some in last week's budget. At its heart is a plan to increase research and development investment from 1.7% of GDP to 2.4%. The government managed to persuade 2 big pharmaceuticals companies to announce a combined £1 billion investment, creating hundreds of high-skilled jobs at 2 sites in Manchester and London. As well as pharma, the government has targeted key areas in which it hopes Britain can be a leader: artificial intelligence, driverless cars, and low-carbon technologies. Technology continues to be the major stock market driver at the moment, with Wall Street ending a holiday-shortened week with new records highs for the S&P 500 and Nasdaq indices. It was the best weekly performance for the S&P benchmark since early October. Markets were also strong in Europe and Japan. Europe in particular is benefiting from a pickup in business confidence as global trade bounces back. Germany's export centre is a major beneficiary, and this has more than offset heightened political uncertainty following the failure of Angela Merkel to put together a workable coalition government. In traditional stock markets, despite the new records, no one is really talking about bubbles. These remain a grudging bull market in most cases. The bull market in Bitcoin, however, is anything but grudging. Having risen from $1,000 to $10,000 this year, the cryptocurrency, which hardly anyone uses, is in the grip of a stupendous speculative frenzy. With trading in Bitcoin futures about to start on the Chicago Mercantile Exchange, the ability to bet against the asset may well see a reversal of that trade. And after such a spectacular rise, it's a brave investor holding on for further gains today. Across the Atlantic, attention is focused on tax reform and the Federal Reserve this week. On taxes, President Trump is due to meet with Senate Republicans ahead of a vote on reforms expected towards the end of the week. The Senate tax bill aims to lower the corporate tax rate from 25% to 20% by 2019, but with the Republicans enjoying a slim 52-48 majority in the upper house, legislation is far from guaranteed. It's also a busy week for the Fed, with confirmation hearings for Jay Powell, the president's nominee, to replace Janet Yellen as Fed chair. Markets are unlikely to be much moved by the process unless there is evidence of opposition to Mr. Powell. He's a centrist on monetary policy, so the Fed's current cautious tightening program is likely to continue through and beyond the transition from Yellen to Powell. Meanwhile, Ms. Yellen is due to testify before Congress this week. Her comments come after she said last week that low inflation could be dangerous. She's worried that rates could peak at a historically low level, limiting the scope for the Fed to intervene as and when there is another financial crisis further down the track. Closer to home, the main political focus is inevitably Brexit. The next 2 weeks look to be crucial. While the UK seems to have made progress on the issues of the financial cost of leaving the EU and the future of EU citizens living in the UK, the third obstacle to detailed trade talks, Ireland, remains as intractable as ever. The Irish government has made it clear that it will not be able to accept the re-imposition of a hard border between the Republic of Ireland and Northern Ireland, fearful that it could reignite divisions healed by the Good Friday Agreement. However, the UK's insistence that it will be leaving both the single market and the customs union makes such a hard border seem unavoidable. Without agreement, Ireland has the ability to veto the start of trade talks, and it seems to have the support of fellow EU countries in taking that hardline position. In other market-related news this week, oil ministers from the OPEC oil-producing countries will meet in Vienna. The meeting comes a year after the group agreed to reduce production by 1.2 million barrels of oil a day to 32.5 million barrels for an initial period of 6 months. OPEC was joined in January by non-OPEC members, including Russia, and the enlarged group agreed to extend this output cut until March 2018. Expectations going into the Vienna meeting are that current production levels will be maintained throughout 2018, and that should support the price of crude at today's levels above $60 a barrel. Any further move upward, however, remains dependent on the level of output from North America's shale fields. But for now at least, OPEC and its allies seem to be holding a disciplined line.